please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
This is Bazaar Morning Call, live from the CNBC TV18 headquarters in Mumbai.
Good morning. Welcome to Bazaar Morning Call. I'm Lata and with me are Anuj and Sonia. Well, there is a dash of green on the Asian screen and, well, a little bit on NASDAQ as well after 4 days of falling. Well, the way we look at it is that there are no fresh negatives from the global markets for Indian equities. More importantly, crude is at 77.5. That's where it approximately was when we closed yesterday. It was north of 77, and the dollar index is now a little bit down, 91.2 compared to 91.4. So we could take these minor positives to check if it will at least stop the pressure on the rupee. We can't be that sure. Yesterday there was incessant pressure on the rupee despite the Reserve Bank sales, dollar sales, bringing the rupee from 70 to 67 to 70 to 30. By the time it was end of day, it was 70 to 45. So you could sense the pressure that at every level, and especially if you're getting a good level, people will come and buy dollars. And likewise on bond yields, 8.16 is a level which throughout the trading part of the market, we didn't have 8.16, but by end of day, it was 8.16. So while we did see not capitulation, we did see a lot of fall in NBFC stocks. I'm wondering if, the economy has come to terms with a 10-year, the best yield is 8.15, which the government pays. Everybody else has to pay, some 2 percentage points more than that. Has all that factored in is a worry. The cost of capital has become so much more expensive in such a short time. I'm not very sure if all that is in the price. So maybe the worst of the storm is over, but I'm not at all sure that there is calm here.
Okay, you spoke about incessant selling on the rupee and the bond yield moves. There was so much selling in the equity markets as well, right? Almost a 500-point slide yesterday on the Sensex. And if you look at the numbers, Lata, by the way, morning Anuj, morning Lata, selling of what? 850 crores by FIIs is what you saw yesterday in the cash market. There was quite a bit of delivery-based selling in a lot of large cap names, 350 crores in Reliance, 300 crores in ICICI Bank, in SBI, etc. And, give and take everything, if you look at the way the emerging markets have performed in 2018 so far, MSCI EM index is down 10%. MSCI India is not as bad. It's down 5%. Asia ex Japan is down about 9%. So the cuts are getting deeper. Anuj, morning. The question I have for you is, generally when you see this kind of weakness in the rupee, export-oriented sectors and zero-debt companies are the preferred lot. We've seen it play out so far like this. You think this could be the trend and this should be the way to approach stocks? And also on the index, what would the view be for the day?
Morning, Sonia. Today is the best day to sell IT stocks.
Okay.
Let me put it that way. But look, we've been talking about this now for some time. This is an emerging market problem. This month in particular, MSCI emerging market is down 3.5%, Asia ex Japan 3.7%, and India has now started to underperform. So 4.2% for this month. Of course, we are all talking about this in dollar terms. So obviously, the rupee has been the worst performing currency for some time, and the way things are shaping up, it frankly doesn't look like it's going to stop anytime soon. So obviously, there's a bit of a problem. I think that's the other issue, and we raised this point at the start of the series, and since then the market's fallen quite a bit. Look at the big stocks. That always will tell you what's happening. HDFC Bank, HDFC, IndusInd Bank, Hindustan Unilever, Bajaj Finserv, Bajaj Finance, Kotak. All of them are down 8 to 14%, backed by strong delivery volumes. Who are selling these stocks? Obviously, institutions. And also if you look at the FI data, the poker terminology that I use, FIs have gone all in with index shorts. Yesterday also they added about 12,250 index shorts. Bought 45,000 puts, sold 17,000 calls. It's a trending move right now for the market. There's no point looking at moving averages, no point looking at support levels right now. This market at some point will find a base, but there's no point trying to be brave in this market and trying to be, if you're a trader, trying to be cute here. It's a market which has broken trend line. If you look at the bank Nifty, that can easily correct another 500 points. Even IT index, as I said, is now due for a 4 to 5% pullback after the kind of run that it has had. And normally when you see upgrades right at the, 52-week highs, that's the time to be a bit cautious. What this market needs is something to scare the bears. You know, you need a scared bear is the biggest bull. Right now, the bears believe that, you know, they can just run amok. So the risk here is something come, and that will have to be global plus local. Something come which will scare the bears. 40, 50 point intraday rallies won't scare the bears. You know, like for example, Hang Seng, just see the chart. Every time it rallies, it falls. What you need is something that would be so big, so ferocious, which, you know, on one given day, for example, moves the rupee by 1 rupee, or, you know, moves the Nifty by, say, 100, 150 point intraday. Till the time that happens, it's a market where all bounces will be sold into. Once that scare comes, you will see a rally, and that too backed by vengeance. But till that happens, you know, you as a trader, you have to respect the screen, which is telling you that emerging markets is a bit of a problem. And this, perhaps, we are in the middle of a correction, nowhere near the end of the correction.
So basically, you're saying that this is still a bull market and it's a corrective phase. That's the trend that we are looking at,
you know,
right?
that's the best way to look at things right now. That, you know, it's a bull market which is going through a bit of a step back. Technically, some hint of a head and shoulder formation as well. But, you know, I won't give too much importance to that right now. As I said, you know, what you need right now is to scare the bears. Right now, they're not scared, and right now they want to just, you know, after a long time, they got something going for them, and they want to take advantage.
Well, at the moment, there's nothing in the global market to suggest that, you know, the emerging market currency crisis is going to end anytime soon. But there's value. And I can remember very clear as daylight in 2013, when the rupee kept falling day after day for very good reason, because, you know, we were fragile. At that time, we had a current account deficit of 5.4%. Here, we could be approaching 3. I mean, the lag number is 2.4. We could reach 3, so we are not in that camp at all. But even last time, with those ugly numbers, the selling exhaustion came. At one point in time, it looked like the rupee is value for this level. And my sense is that we are not far from that level in the rupee. I mean, this is a country with an inflation of only 4.5%. Or maybe, you know, trending towards 5, because now the imports will become expensive, crude will become expensive because of the rupee. But it is still, you know, value at that level. At some point in time, people will think that rupee is value. And, you know, there will always be overshoot before they think that. And that's why in our poll, we saw 20% people saying that it could overshoot to 74, and then people will find value. Now, we don't know what is that overshoot zone, but I can be very clear that we are very close to value zone. It has to be perceived that way, and then when the rupee starts falling, you know, you can find stability in other markets. But this will be the arch market, the anchor market. The other point is it's possible that some such salve comes from the government in the form of announcing some very strong export incentives. I hope they don't announce an NRI bond. That's the wrongest thing to do at this time, because, you know, just a handful of people you know, find it favorable. Of course, it helps the overall economy. But if it were export incentives, it would be more economic in nature. It could improve labor. So some such strong package announced could just time it. It's only sentimental. I mean, that might overall increase your exports by probably $1 billion. But the very announcement, and if it coincides with the exhaustion of selling and the very crystal clear value you see in the currency, a coincidence of that may be the best anchor that we can look for at this point.
Okay, well, let's see how things shape up. For now, the SGX Nifty is suggesting that the start will be in the red. A mild red tick. I think it's down almost about 20-25 points as we speak. But let's take a look at what our wise experts have to say as we head into trade this morning. Anish Damania of IDFC Securities says IT and pharma have been the best performers in the last 3 months, finding support from the depreciating rupee, while the CNX FMCG saw a correction in the last 1 week, led by valuation concerns. He believes the recent correction in rural consumption story should be used as an opportunity to buy, as he expects rural consumption to stay strong for the next 2 to 3 years, led by structural strength in the rural economy. He maintains the FY19 Nifty target at 11,550 to 11,980. He says large caps that they like are Maruti Suzuki, Coal India, NTPC, IndusInd Bank, GAIL, Hero MotoCorp, Dabur and Aurobindo Pharma, while the small and mid caps that they are betting on include NMDC, AIA Engineering and Indian Energy Exchange.
I only wonder when people will have the courage to buy all these stocks. It doesn't seem like today. Okay, some money market views, and there's so much churn in those markets. Bhaskar Pranav of HDFC Bank says overnight dollar has remained stable above 95. Global crude prices also have remained range-bound. Hence, emerging markets may remain a little more stable today. There is more hope than a prophecy in what he's saying. In Indian currency markets, it's been almost a one-way journey, only to pause on some verbal cues from the powers that be. Bhaskar adds the same scene is likely to continue today, and he expects a broad range of 72.35 to 72.65 against the dollar.
And on the bond market, bond yields now at 8.16%, the highest since November 2014. Bhaskar Panda says the benchmark yields in Indian bond markets have moved up due to rupee depreciation and higher global crude prices. He says the 10-year benchmark could trade in a range of 8.10 to 8.20% as well for the trading day.
Okay, some bit of stability in global cues. Let's hope, from the bull's point of view, that sustains. But here's Nigel with the world view.
Well, after 4 straight sessions, we at least had some green on the screen for the S&P 500 as well as the Nasdaq. The Dow, though, ended with some losses. 2 big gainers in yesterday's trading session. Facebook did put on some weight. Microsoft as well was up close to around 1%. But 2 of the largest stocks in terms of market capitalization did end in the red. Apple as well as Amazon. And that's what prevented the indices from really moving up. Remember, worries regarding the trade wars, that really continues, and that's really plaguing the markets from moving up as well. European markets, well, they ended in the green, all the 3 frontliners. There were hopes that, in fact, Brexit, there could be a deal out there in the coming weeks. And on the back of that hope, we did see those markets do well. But if you're looking at the emerging markets, you're looking at the peripheral indices, well, the Italian index, that had a big run in yesterday's trading session. What the Italian government said is that the 2019 deficit won't disrespect European fiscal rules. And on the back of that, that index was up. But it wasn't just the Italian index. All the other peripheral indices as well ended with gains of around 1% to around 2.5% odd. We were focusing on the dollar index. That's cooled off a tad bit from around the 95.5 odd levels. There was some strength that we're seeing in the sterling. In fact, the sterling is at a fresh 5-week high in comparison to the dollar. And that explains why, in fact, we are seeing some cooling off in terms of the dollar index. 2 big central bank meets this week. We have the Bank of England as well as the ECB. Nothing really is expected out of there except for the commentary. Brent crude prices still holding at those elevated levels of around $77.5 per barrel. Asian markets, some of them were holding in the green. All of them now, in fact, they have come off the high point of the day. Most of them trading with a bit of a cut. The SGX Nifty as well is indicating a start in the red. Back to you.
Oh, yes, so it is, Nigel, so it is. And if you looked at the Asian currency index, again, it's all a 0.25% higher dollar versus any currency you can pick. So, well, the start is looking a little ominous. Let's leave you with some very important opinion before we go into a break. In our ongoing series, Lehman Crisis 10 years on, I spoke with the former Reserve Bank of India Governor, Raghuram Rajan, not just on the development since Lehman, but also on the state of the global financial markets now. And a very encouraging thought that came from him is that developed economies are not decoupled from emerging economies. And if emerging economies' growth is hurt by tariff or whatever reason, then developed markets also cannot grow. His regret is that the US administration is not realizing this coupling effect. Listening to the governor, the man who saw the previous crisis much earlier, we're coming back and then discussing micros.
The reality is much of world growth now is driven by the emerging markets. So the industrial world cannot be decoupled from growth in the emerging markets. We need both to grow if the industrial countries are to do well. We have an illusion, a temporary illusion, that the industrial countries are growing and growing strongly, and it doesn't depend on the growth in emerging markets. That's an illusion that will crack if, in fact, the emerging markets slow considerably. I think the Argentinian and Turkish case are special. They have had a history of problems, and this has come to the fore recently. It does signify some concern for other emerging markets. This is not a good time to abandon macro stability. You have to focus on reassuring markets that you are good for it. And unfortunately, countries that have growing current account deficits, that have large fiscal deficits, look particularly vulnerable at these times. You also have a large fiscal deficit. Of course, the center has been relatively moderating, but the states have increased their fiscal deficit, and when we aggregate government fiscal deficit, it is quite large. I think the fact that India is growing quite strongly gives it some positive. But in general, I think we have to pay attention. Now, the current account deficit is partly a result of oil prices going up, but it's also partly a result of our export sector having been hit by the twin shocks of demonetization as well as the GST. My sense is the slowdown in credit essentially implies that there will be relatively few projects to get into trouble. This is not good news. We do need far more investment. Sure, there will be NPAs from that investment, but hopefully at a much lower level if credit is sensible. But the fact that credit in general has slowed is a concern because it reflects concerns amongst bankers, amongst promoters about the overall economic environment, and that has to change for India to grow more strongly.
We wake up to relatively okay cues this morning. It's flat across most of the Asian markets. Some of them are in positive territory. This after the possibility of President Donald Trump and Kim Jong-un having a second meeting. So there are plans to sort of coordinate that. The other markets, Taiwan, Kospi, Straits, are all trading in the red and are starting to move to the low point of the trade. So just keep an eye out on that as well. Our research team is here to give you the list of top 10 stocks to watch as we head into trade today. Anuj, what would you be looking at given the context of the market mood?
Yeah, I think the context is quite bad still, Sonia, there's no doubt about it. Edelweiss is a stock that I'm watching on the red side. It's seen aggressive delivery selling. The NBFC rally has halted. When the leader starts to fall like it has, obviously there's a bit of a problem. So from 320 to 256, it's decent correction and backed by delivery volumes. The other one is Tata Global Beverages. It ended 6% off its highs yesterday, and we were discussing that news was perhaps already in the market. The high was also the 20-day moving average, so it perfectly coincides with the 20 DMA halt. Of course, the stock is in a bear market of its own, so that could see some further pressure.
Okay, that's important to note, those two stocks. Though, of course, pressure is going to be there on several stocks. Rima, well, Anuj is not so confident about tech stocks, but nevertheless, the brokerages are?
Yes, Lata, absolutely. So Merrill Lynch is a very interesting thought. They believe that it's realistic to assume that IT companies will be able to enjoy the benefits of the first 10% of the currency depreciation. So the move from rupee 65 level to 72 rupee. Two key reasons for that. One, small moves in the currency do not spark off immediate renegotiation talks with vendors. And secondly, IT companies bore the brunt of rupee appreciation in FY18. So that will be a positive. Macquarie says that while the impact and the benefit on Indian IT companies will be different for different companies, they see the maximum positive impact on TCS, Tech Mahindra and Persistent. They've also upgraded Wipro and Hexaware to an outperform on the back of valuations. So Wipro target price is 350. For Hexaware, the target price has been increased to 560. And they believe that Infosys should continue to trade at a 20% discount to TCS.
Okay, Rima, thanks a lot for that. So that's the boost that the IT sector could get. I mean, some upgrades coming in there. But Ritu's joining us on the phone line to talk about Essar Steel and the latest over there. Ritu, hi, morning.
Hi, Sonia. It's very good news for the lenders because we understand from sources Arcelor has made a revised bid which is far higher than the other bidders and far higher than what it had proposed in the first round. We understand it wrote to the Committee of Creditors and said it will now offer 42,000 crore rupees to buy out Essar Steel. In fact, it added that this will be on top of another 7,000 crore rupees that it will pay to repay dues of Uttam Galva Steels and KSS Petron to remain eligible to bid in round 2. Further, we also know that New Metal had offered 37,000 crore rupees and Anil Agarwal's bid was close to 34,000 crore rupees. So, ArcelorMittal does remain the highest. It remains to be seen whether or not the Committee of Creditors will accept this revised bid because the second round of bids so far has not been disclosed, officially to the Committee of Creditors. Only the IRP opened them yesterday. But that said, the matter is far from done. ArcelorMittal has also moved a petition in the Supreme Court against the 7th September NCLAT order that declared it ineligible. It claims that, in the second round, it had divested stake in Uttam Galva and was therefore eligible, and that the court was applying differential standards between New Metal and ArcelorMittal by asking ArcelorMittal to repay dues but not New Metal.
Okay. Well, thank you, Ritu, for that news break. You, of course, told us this evening yesterday. The important point is, there's a positive coming in the way in terms of Arcelor paying much more, but the negative is they're also going to take the NCLAT order to the Supreme Court. So the money could come much later. It's certainly not there in the September quarter. I mean, if it comes in the December quarter, SBI is lucky. So green for SBI, but it looks like it's a delayed green. There could be other factors which will push it down before the stock goes up. But here's a very big exclusive from someone who absolutely knows the ins and outs of the insurance space. Our insurance reporter, Yash, has some exclusive that the IRDA is seeking in terms of concessions for insurance companies. Go ahead, Yash.
Well, Lata, certainly a big positive for the listed insurance companies. What we're given to understand is that the insurance regulator IRDA has reached out to SEBI, and this is with respect to getting certain concessions or recommending a few points or changes with respect to the minimum public shareholding norms. As we all know, SEBI rules mandate listed companies to offload 25% of their stake in public within 3 years of their listing period. But IRDA here has said that it is not an ideal situation where insurance companies transfer 25% of their risk into public within a short period of 3 years. And hence, an extension is something that these companies should be given as far as offloading that 25% stake is concerned. If a time extension is not given, then SEBI should consider reducing that quantum, which is the 25% offloading in public for these listed insurance companies. It's not just that. IRDA has also said that these insurance companies should be allowed to raise more than 25% of their net worth from Tier 2 bonds. Remember, current limit is 25% of net worth, but yes, a raise is what IRDA has demanded. Certainly, as far as the minimum public shareholding is concerned, except ICICI Lombard, all listed insurance companies, be it ICICI Prudential Life, New India Assurance, as well as GICRE, are yet to complete that 25% quantum in public. So a major positive, as they will get a more time extension as far as offloading that stake is concerned.
Yes, Lombard, obviously promoters, Yash, thanks. Promoters have 55%. HDFC Standard Life was the recent IPO that there's 80% is held by promoters. ICICI Prudential is where 78% is held by promoters.
The overhang that immediately people will have to, offer shares is not there.
It's not there.
And I think that will be the very big positive for listed stocks. And basically, even his other themes, like they can raise more Tier 2 capital, also gives them, a little more scope to raise money. So, Yash, congratulations. That's a great exclusive. But, of course, let us remember that this is consultation between IRDA, between the two regulators. Not at all a done deal, but could be the shape of things to come.
Right.
Okay, thanks a lot, Yash, for joining us. Let's move on. Shrey, infrastructure is in focus. SEBI has now given the nod for the IPO of Shrey Equipment. So Abhishek will tell us more about that. Abhishek?
Good morning, Sonia. So as you mentioned, SEBI has given nod and they have put it on exchanges last evening that they have got a nod of IPO for Shrey Equipment. So the company did mention to us earlier that they are looking to have two kind of a stake sale. One is offer for sale and one is the fresh issue. Shrey Equipment Finance will actually finances infra manufacturing goods. So the company is looking to raise anywhere between 1,500 to 2,000 crore for a stake dilution of 25%. Shrey Equipment Finance had filed its DRHP with SEBI in November 2017. So the stock may be in green on account of this hangover getting over. Back to you.
Okay, thank you very much for that, Abhishek. Well, ILNFS Group, yesterday we saw all those listed stocks, ITNL, ILFS, investment managers, and the third listed stock, all of them go through deep pain, of 10%. Today, there looks like there is fresh trouble. ICRA, the rating agency which downgraded the group in holding company yesterday, has now downgraded a whole series of subsidiaries, solar companies, power companies that have, investments in various parts of the country. It looks like that those bonds will be held by a lot of insurance companies, a lot of mutual funds. So this could be bad news, as well as we heard yesterday, 60,000 crore is banking sector's exposure. SBI as Central Bank are one of the owners of IL&FS Group, along with ICICI, along with LIC, sorry, not ICICI, LIC and Oryx. So these two listed stocks, as well as other banks, would be under pressure. It's not very clear where the 60,000 crore is sitting, but surely the entire banking sector is going to be affected.
Okay, well, yes, we did speak to a lot of people yesterday, and they told us about the kind of damage that this would have, 60,000 crores of exposure to the banks. But Sonal is also with us. Sonal, what are the other stocks that you are tracking this morning?
Thanks a lot for that, Sonia. And yes, I'll start with Ujjivan. I'm tracking that stock because Macquarie has written on the company. They maintain their outperform rating, but they've cut the target price to 460 from 490 per share. And target is cut because they want to build in higher cost of funds. But they also believe that the company is on track to deliver 35% loan compounded annual growth rate and 16% return on equity by FY21. The other stock I'm watching out for is Reliance Home Finance because it reported its Q1 results yesterday. The AUM was up 21% on a YOY basis at 15,600 crore rupees. However, the net interest margin fell to 3.2% versus 3.8%, and the profits came in higher by 55% on a YOY basis. Back to you.
Okay, well, here's a quick recap then of our top stocks to watch today. Stocks which are expected to have positive news flow, names like TCS, Wipro, Hexaware, Shrey Infra Finance, SBI, PNB, HDFC Standard Life, SBI Life, ICICI Lombard and ICICI Pru. While stocks with negative news flow this morning, Edelweiss, Tata Global Beverages, Ujjivan, Reliance Home Finance, you have IL&FS Investment Managers and ITNL.
All right. Well, with that, let's shift back to the markets and to macros, because at the moment, the market is getting beaten down by this big macro called the rupee. It did recover a touch yesterday after going to an all-time low of 72.67 on fairly incessant Reserve Bank supply of dollars, but indications are the slide could continue. Even yesterday, after touching 72.3, the rupee by close of trading was at 72.45. Jahangir Aziz, the Asia economic research expert at JP Morgan, joins us on the phone line from New York with his take. Good evening to you, Jahangir, and thank you very much for staying up to take our call. It's fallen a goodish bit from the 69 that it was to 72.5. It's a 13% fall year to date for the currency. Do you think people will start looking at value now?
Look, I mean, as we had spoken last week, I think the rupee, depreciation is a reflection of fundamentals, and till those fundamentals are addressed, I don't think. Thinking in terms where the rupee has cheapened sufficiently for people to start looking at rupee and positively. I think that requires the fundamentals to be actually turning around, and I don't think that has happened. Until you actually see the current account deficit, the fiscal deficit and interest rates actually turn the other direction, I don't really think that you can stop, waiting for the rupee to find a bottom simply because it's depreciating. If you look at it in terms of nominal effective rates or trade-weighted rates, the rupee basically has depreciated along with all its competitors. So I don't really think that the rupee stands out as exceptionally cheap if you look at it across Indonesia, China, etc., in a trade-weighted basis either.
Okay. Jahangir, hi, good morning. So you're saying the rupee is not cheapened sufficiently to become a buying opportunity now. But, the RBI has been selling dollars to arrest the rupee fall. What do you think the next step from the government or the RBI could be? Because there are suggestions that they could be tapping sort of NRIs for raising forex, etc. What do you think the next move could be?
Look, I mean, I know it's been floating around for quite a while. Look, everybody keeps pointing to the 2013 episode. People forget that when the government at that time went in for tapping NRI resources, it had already raised interest rate 300 basis points, and the fiscal deficit was squeezed significantly in those 4 or 5 months following the taper tantrum. So, India can try going to non-resident Indians or non-resident foreigners, doesn't really matter, and say, look, we want to tap you for resources, but we are not willing to do anything either or do sufficiently enough either on the fiscal deficit front or on the interest rate front. I don't really think it's going to work that way. It hadn't worked in 2013. It is unlikely to work this way. I mean, there has to be a policy down payment that has to be paid first before you can go and tap onto these resources. Once you put the policy down payment, then of course you can think of different kinds of schemes, etc., to get capital flows in. But till you put the policy down payment, I really don't think these kind of things are going to work.
The Indian central government fiscal deficit is not, in the blowout stage it was in 2013. It has been largely respected year after year. And even now, the government, for instance, has not cut excise on petrol. It's bearing the political brunt, but it's not doing anything irresponsible. So won't that convince? And for instance, if in October there is a rate hike, I mean, what can turn the tide? Will it be an announcement of an export package, or what can turn the tide?
Look, we can talk in terms of the central government versus the state government. At the end of the day, it is the general pool of savings from where both the central government and the state government are taking out resources. The year of taper tantrum, 2013-14, the overall fiscal deficit, center plus state together, was 7% of GDP. The last year, 2017-18, it was 7.2% of GDP. So yes, the central government may have cut down its fiscal deficit, but overall fiscal deficit has widened. And the amount of resources it's taking out is substantial, given the fact that, if you believe the growth numbers, India is growing at over 8%. In terms of, interest rate processing, I know that the RBI has raised rates twice already in the last few months, but, waiting for October, that's about, 3 weeks away. When the world is changing so rapidly, 3 weeks can be a lifetime. I think if the RBI wants to have...
so what are you expecting before that?
I would have thought that by now the RBI would have shown sufficient urgency to start raising rates now. Okay. If RBI plans to raise rates in October 3, why not raise it now? Because raising it now is going to be far more effective than waiting till October 3 when things could have changed quite dramatically, and then raise it, and then the interest rate hike just becomes ineffective.
Okay, so you're talking about the need of the hour is an earlier than expected rate hike or inter-policy rate hike.
Exactly. I'm expecting that. Look, I'm not saying that they should raise rate. That's up to them. But if they are planning to do it on October 3rd, September 12th is just as good or even better if they want that rate hike to be effective in stemming the rupee slide.
So, things have weakened substantially over the last fortnight. And as global uncertainties escalate, do you think emerging markets like India that are running twin deficits could see, a downside risk to growth? Are we looking at a growth outlook being scaled down further?
Right. So the question is, was August very different from April to July? I think August was different from April to July because between April to July, the financial market was reassessing developed market monetary policy, and that was being reassessed. In August, I think financial markets actually started to reassess emerging market risk per se. And I think it's a different way in which the emerging market, financial market is looking for it. And if the government isn't willing to cut its deficit, if RBI is not willing to raise interest rates to stem the current account deficit, then the current account deficit will necessarily have to be closed through a significant slowdown in growth. I think Sonia asked me the question, last time when we spoke, and my answer is yes. In the absence of any policy response, then it will have to be growth that needs to slow down and to bring down the current account deficit.
Okay. Just a final question, Jahangir. Globally, what might bring some calm to the global EMs. The trend has started. Something has to stop it. Is there any external event that can ensure that?
No, I mean, there are a number of them, right? I mean, look, I mean, if, for example, let's say the tensions about trade, both in NAFTA, with US, Canada, and Mexico, or with China, or with the European Union in terms of auto tariffs, if that comes down, obviously that's going to be a big positive for emerging markets because it's going to take down the trade risk, which is a key risk for emerging markets. I think, there are events that can happen that can actually calm down the market tensions, and but those are exogenous events which are outside the control of India. And the point which I've been sort of trying to belabor is that we haven't really seen sufficient policy response coming, despite the fact that we've seen current account rising and the rupee weakening.
Fair point. Jahangir Aziz, pleasure speaking with you. Thank you very much for joining us. Clearly, President Trump or any of the international figures are not any closer to smoking the peace pipe. But yes, India could look like it's taking some emergency actions. But let's wait and see what happens. That's a very interesting trend of thought, an inter-policy hike. It was in the markets about a week ago, but it didn't look so bad, the rupee, at that time. But now perhaps more people will start thinking on these lines.